Ready?
Yeah.
Okay, let's do it.
For it.
Hello, world. I'm here with Christi. You're listening to the Reed Fletcher podcast. Christi, if you could give us just a tiny intro about you.
Sure, yeah. My name is Christi Larsen. I'm a mortgage loan officer. I work at a company called Security Home Mortgage. We're what's called a wholesale correspondent lender. So we originate loans and we then pass the servicing to people, places like Wells Fargo and U.S. Bank and, the big guys.
Yeah.
And yeah, I call myself a mortgage mermaid on social
I saw
media.
That. I saw
so
that.
Exciting.
Are you, when you look around, you're in an office setting? Is that how it works?
Uh-huh.
Are you like really different than the typical loan officer? I mean, you have the different hair. You call yourself Hint of Nerd on Instagram, all that. I don't know anything about loan officers, so that's why I'm asking.
That's a legit question. I actually started in the industry a couple of years ago as the CFO assistant there.
Mm-hmm.
And I kind of worked into like this HR accounting sort of role.
Mm-hmm.
And then from there, I just really, really enjoyed like how much like benefit the different things like you could do with mortgages could benefit people.
Uh-huh.
And so I got licensed and I originate, and I'm actually doing a lot more than I ended up thinking that I would at this point in time. And so I actually am a lot different in that sense where I actually have like a full-time like other job with like the HR and accounting. And then I do the loans also.
So you do the HR and the accounting in addition to, is that what you're saying?
Well, actually I started there. And then in addition to that, I'm doing loans and it's like more and more. And who knows, eventually maybe I'll just completely drop the other one. I really like it, doing loans.
How long have you been doing it?
Let's see. I've been licensed since 2017. So a couple of years.
Is the licensing process pretty rigorous?
There's about 15 hours of education you have to do. They do like extensive background checks and stuff, obviously. You're dealing with people's personal information.
Yeah.
You have to make sure you're not like some kind of convict or
Yeah, not going to run away with their down payment.
Oh, I know how I'll do my next week. No, yeah. So there's like 15 hours of education and then you have to take a test and, pay the money and get licensed and that kind of stuff. So the tests, you have to get like 80% on like most, state level tests. So yeah, so you get licensed in the different states. So I just originate in Utah.
So my wife's from Arizona. Like if she wanted to buy a house in Arizona or California, we need to go to someone from that state in order to do it. Like,
not necessarily from, but they do have to be licensed there.
Okay.
So for example, my company itself is licensed in like California and Colorado and like the other states, but I myself am only licensed in Utah because I don't really have a reason to be licensed in other places. But there are loan officers that I work with that are licensed in those places. So you don't have to like go to a place that's located there, but you could
work with someone who lives in Utah, but they have a license in Arizona.
Right, exactly. Because each state has like regulations that they have to follow. So right.
No, I figured, and I know that's the same with real estate agents too, right? Don't you have to be licensed in each state?
Yep. So most real estate agents you'd see here are like gonna mostly just be in Utah because especially with how hands-on real estate work is.
Yeah.
I mean, it would kind of be silly to have a real estate license in California or have to drive 12 hours to like go help a client.
Skype someone, like go check out the house yourself. Yeah.
Exactly. So that's just a big part of that that industry, I would say, or not industry, but that role is, going with your clients to those places to make sure, they have the full picture. It's a little hard when you're not there. So.
Yeah, no, I would imagine. But so for a loan officer, because you're not so much selling something as you are just helping, right? Because no one comes to you. They're not like looking for a house or anything. Basically, they already have something and you're the one who's just trying to get them the best loan. Right. An easy way to.
So they can shop. Like I can sell them my product as the best priced option, but it's something they're going to need inevitably if they're going to get into that house.
Right.
Unless they happen to have lots of cash, which is great, but most people don't.
Right, yeah. Put like $500,000. Like, I'll just buy this house in cash.
Yeah, we're fine. Which, yeah, I mean, it can happen sometimes, you know, if you're like downsizing,
right,
you know, from a larger house to a smaller house, and you have, you know, like X amount in this house, it obviously covers a smaller house when you sell. So
I guess that makes sense. Like, you know, grandparents or something. My grandpa, he bought his house in like 1950 and sold it in 2005.
Yeah.
And so he ended up making like
thousands of dollars. Yeah.
$500,000 in cash and just put that right into his house.
And he probably paid like $50,000 for it.
Probably. Yeah, exactly. Like way back when.
Yeah.
And it was a ton for him. You know, and
sure. Yeah.
And his mortgage is, you know, $125 a month.
Yeah. Which like we're like, oh, that's great now, but it was still a lot of money back then. Just as much as a mortgage payment would be now, probably. So. Yeah.
I guess that probably doesn't really change that much. It's just inflation.
Right.
And so we hear it and we're like, oh, yeah, it's so lucky. But in reality, I guess it depends, because something like college is also more expensive in relation to inflation. You know, because like back in the day, it was cheaper because of inflation, but also it's like way more than inflation now.
Yeah, no, I get you. I'm following. So basically, like, I mean, a pretty standard, it's not great to have like more than probably like 40-50% in your like total debt to your income, like a percentage. And so in that respect, you have, you know, probably the same thing in the 50s where it was $100, but that still might have been 50% of his income.
Right. Yeah. Right.
So
yeah, if he could have a job today but live in the past,
yeah, that would be
the
sweet.
perfect thing.
Yeah, when time travel gets there, we'll all just be great.
That's funny.
We'll just like wire this money back.
Yeah, exactly. So one of the things that I've heard, like I have like the most, you know, basic level knowledge of getting a loan. I don't own property. I live in an apartment. But you mentioned debt to income, which is a big one. Credit.
Yeah.
Like, are there other big things that people should worry about before they get their first home?
Yeah, I mean, it's really good to consider how much you can bring into a house. There's definitely options that you can do, like a 0 down option. But the interest rates will be higher because it's more risky. And the payment's going to be more. And so in a lot of cases, it's still better because it's better than just paying $1,500 of rent to nothing that you don't get equity in.
Yeah.
Whereas maybe you can get a house that's the same size for $1,600. And then if you like brought a down payment, it would only be $1,300. You see what I'm saying? So there's definitely something to be said about if you can bring your own cash, you're going to pay less ultimately if you bring more to the table when you start the loan.
So basically, the bigger the down payment, the less your monthly payment.
Right.
Probably simplified a little bit, but
I mean, it's really, the idea is the less the loan amount is,
the
lower the payment will be.
Yeah.
You know, over your regular standard, which is 30 years.
Yeah.
For a mortgage. Yeah. In addition, I mean, you could bring like 10% down or 20% down and maybe have a similar interest rate. But if you bring nothing down, then that's going to be like, that's going to jump your rate up, because it's just, if you bring less skin to the game, you know, the lender's going to consider that. And where there's great programs to make it possible for people to own homes, you're still going to pay a little bit more. So,
do you think that's worth it to not fork over the down payment, but have in the long run pay more?
Is it worth it to pay more? Well, you can always refinance. So, for example, we own a condo in Pleasant Grove. We bought it for like $160 a couple of years ago, and now it's like $220,000. So we haven't paid down $60,000 because we've only had our loan for 2 years. But like, then because I have so much equity in there, you can refinance, which makes it less of a risk factor for the lender, and so you can get like lower rates and those type of things. So if you think about it, for paying more for maybe only 2 years, that's, you know, pretty acceptable for most people, because then they can put them in a place where they can then kind of catapult themselves into a better beyond future.
Yeah.
So I think if you can get into a house for a similar payment than you have now and you're still bringing nothing down, I think you're winning personally. But
right. No, and it makes sense. Like, because if you're paying the same amount for rent, you're paying the same amount for something you own, at least you're getting equity.
Literally paying someone else's mortgage. So you may as well pay your own if you qualify.
So do you guys have renters out there?
Yeah. Mm-hmm. So we have renters currently there.
Has rent gone up since you've owned it?
Yes. Just because everything's in such high demand here.
So your mortgage, you're basically locked into your mortgage, or better because you can refinance, but the rent can go up. It's like your cash flow
but rent can also go down.
That's a good point.
And you could be locked into your mortgage for longer, like say with what we had happen in 2008, 2009.
Sure.
Where people were buying houses that were maybe $200,000 that were then worth $150,000. Obviously, you can't refinance that because you owe more than the house is worth.
Right.
And so, there's definitely some risk, just like any kind of investment.
Mm-hmm.
But there's definitely like tools that make it a lot more possible, I feel like, for people to feel more comfortable to get into a home. So... does that kind of answer?
Yeah. No, I have a lot of questions about this kind of thing because so me and my wife have been looking to get our first property. And we've really wanted to do investing, either house hacking or just investing in general. Maybe we thought about doing like a fourplex and living in one of them and stuff like that. And so do you work with people like that usually? Do you work with more just residential homes? Yeah. So,
there are lots of people. I don't know if they would. I don't know so much about like going into fourplexes. They're just so uncommon as it is.
Yeah, exactly.
But I know people that have bought duplexes as like their first home, and they put like the lowest down payment that they can, or whatever it is, and then they live in one half and rent the other half, and it's great for them because a good portion of their mortgage is paid by just the rent.
Yeah, exactly.
Yeah, one scenario was that I had somebody where their mortgage was like $2,000 for a duplex. They're living in one side, renting the other side for $1,300.
So and living for
like $700, you're like maintaining this like piece of equity.
Yeah, exactly.
That's gonna really do well for you later down the road. So
yeah, when you got your condo, was there anything that surprised you about the process? Because it sounds simple. Like, like I just like get a condo and then find renters and then, get cash flow. Was there any hiccups that unexpected?
I would say I was actually planning to like be in a place like Orem or something where I thought for sure, like, I won't have any problems. Hey, man, he can edit this out, so we're good.
Hey, how's it going?
Yeah, so originally I had planned to get a place in Orem because to me that made sense with the students, and like I was able to for sure like rent out a place and not have a problem with that, and there's housing demands around there. But then as I did more research and we had a really good realtor that helped us, we discovered, well, actually that's probably not the best because you're going to have a lot more wear and tear on the property, a lot more turnover. The places that we were looking at were like not as expensive, but like they weren't really well kept or in like great neighborhoods, or so there's kind of a risk factor there because if you get something, it'll always be rented. Like, don't get me wrong,
right? But
maybe you don't have like the renters that take good care of your house.
Yeah.
So I think that I was surprised in that regard, and so our condo in Pleasant Grove has worked out really well because it's like in a really nice condo complex. Like it's got all its grounds maintained and everything like that, and people are willing to pay more. Usually people that are willing to pay a little bit more are usually going to take care of things a little bit better. And so that's definitely something I didn't think about, and not necessarily a hiccup in the process, but something I definitely learned that I felt like was a really useful piece of information.
Do you have to pay an HOA fee down there?
Yes.
And because of that, they do like lawn care.
Right. So an HOA usually will cover all of like the community stuff, obviously. It's got like a walls out insurance policy. So if there's like damage to the roof or something like that. And then sometimes it'll cover like garbage, sewer, water, that kind of stuff. So it kind of depends on the HOA. But
you said like plumbing maybe or stuff like that? Like,
that it'll cover?
Yeah. Or is that on your own?
So I was talking about just utilities. So Usually HOAs won't cover all utilities. If they do, they're probably like $500 a month.
Yeah. Uh-huh.
But a normal range in Utah County is probably more like $150 to like $250 a month for an HOA. Mm-hmm. So they're going to be paying like sewer, probably not gas, electric, because those are like more. Mm-hmm. But water, they pay all that stuff as a whole. They operate the clubhouse, pool.
Right.
That kind of stuff. So.
Yeah, and that makes sense.
I don't have to own a lawnmower.
Yeah, which is nice. I've heard a little bit of mixed reviews on HOAs. I think it depends on the HOA, but sometimes people say that they have really strict rules. Like you can't park in the street and stuff like that. Or but for the most part, I've heard good things. But what about let's say in your condo, like a toilet breaks or something? Do you guys have any kind of property management that takes care of that?
No, so that would be your own. So it's with HOAs and places that are like all connected with their building. They're gonna have a walls out policy that's covered by the HOA, and that's gonna be things like your roof caves in, or it's just, or maybe something else from somebody else's property comes in. That actually is a gray area, but then you have your own insurance policy. It's usually called an HO5, I believe, and that's just like walls in. It's like $10 or $15 a month instead of like regular homeowners insurance, which is $50 to $100 kind of range. So
right, just because we've always wanted to like own rentals and have tenants and stuff like that.
Yeah.
And the only negative that I hear people say, which I guess I don't know because I've never done it, is having to go in and fix things, and there's like expenses, like if the furnace goes out or something like that. And I don't know, have you had to deal with that kind of stuff at all, or is it mainly covered?
So actually as we qualify for people to get mortgages, it's not considered breaking even unless you're charging at least like your total expenses can only be 75% of the rent in order to break even. So that means you're making an extra 25, and it's for things like that. So I think that yes, there are things like that, but if you've planned, then it's really not so bad,
right?
Because you're making an extra 25 every month, and then when things come up, you have money.
Right. Yeah.
And that's why, like, on my end of things, if I'm looking at somebody that has a rental property, I'm gonna see how much are they charging for rent, what's their monthly HOA, what's their monthly payment, are they breaking even? And if not, it's like the excess is then considered as debt, like monthly debt to them.
Right.
So even though they don't really have a $1,500 a month expense, to me, they have to, because they have to consider that 25 of extra for maintenance.
Right. Because like a capital expenditure kind of thing, maybe once every 10 years, some big expense might happen as well. And now if you have to pay it, it's like you weren't calculated that since the beginning.
Right.
You might have not actually made any profit in the 10 years.
Yeah. And it could be that, like, if there's issues at the beginning, that would be a struggle. But if you've been renting for a long time and you've had like a stash of money.
Yeah.
Like, we just had to replace a fridge, and it wasn't like a huge deal because we've charged more.
Yeah.
So, in order to break even, essentially, and have that mortgage pay for itself and that house essentially pay for itself.
Do you guys plan on doing, is that the only one you have? Do you have other properties?
That's the one we have right now. We'll be doing more though, for sure.
Yeah. Everyone I've talked to is like, it's just, when you haven't done something yet and it almost sounds too good to be true. I'm like, there's gotta be something. Because all my friends that do it, they're telling me, oh no, yeah, it's awesome. Like I own all these properties, and they basically, they pay themselves off, and it's only a little bit of maintenance and stuff like that.
And you can pay property managers too to do stuff for you. Like, you own the property and they take 3% of the rent, and you don't have to do anything.
Like the one that scares me.
You have to foot the bill, but it's very not stressful. Too good to be true.
Yeah.
What was that? What were you saying? I was just so distracted by my spitting. I don't actually know.
Yeah, I had to go pretend to turn off the camera because really I was wiping off.
You're like, oh, it's time.
Yeah, the camera's. That's really funny.
Yeah, you were saying there's got to be a catch. Is that what you're saying?
Yeah, I mean, maybe that's just like the skeptic in me. But...
property management. You said there's something that really scares you. The one that really scares you.
Oh, yes. The thing about property management that really scares me is evicting.
Oh, sure. Yeah, but again, I think that kind of comes with like the kind of property you're renting. Like I like my sister has some rental properties, and I know people that have had rental properties that they just seem to kind of attract the same kind of people that they're having to evict. So it kind of depends on I think it really comes down to what you initially invested in. And so if you've invested in like maybe something with a nicer area that's more expensive that, has, then you're going to have less of that.
Yeah, no, I guess that makes sense.
Yeah.
Is you kind of get what you pay for.
Right. And it might be like stereotypical and, to say that about different areas, but really you'll know if you go into a house and it looks trashed before you buy it, then you're going to charge less. And probably they're not going to care because it already is trash.
Yeah.
So.
Yeah, definitely.
Yeah. So that's my take on that, I guess.
Have you ever thought about any other like real estate ventures, like flipping or wholesaling?
It's too hard.
It's a totally different thing, right?
I don't want to do it.
Yeah. It's a whole skill set.
Yeah, that's a lot more hands-on work. Whereas with what I feel like what we're doing with the housing stuff, it's like we can buy a house, live in it as a primary residence, and until we're ready to move on to our next space and rent it, and you get better interest rates, better down payments, better everything when it's a primary. You get into a mortgage, this really good mortgage. You can rent it out in 5 years when you're ready to.
Yeah.
Upsize or whatever.
Yeah.
So it's just a lot of not maintenance.
Yeah.
So,
it's very passive.
And I think like flipping houses, I think is risky because I've seen a lot of failed flips.
Yeah.
And stuff where they buy and it's way more expensive than they planned. I mean, and you're all in, you're like hard money cash. Like, and if you can't make it on the flip, like you lose a ton of money. And so I just think it's really
and time.
And yeah, tell me about it. Like that's not even considering the time.
Yeah, I mean the difference that I see, because I have never really thought about flipping or wholesaling or anything like that either. The reason being is like in order to be an investor and have tenants and everything, it seems like you need a lot of upfront knowledge and research, and then kind of you can move on with a little bit of maintenance. But in order to do like a flip, you need to have a lot of connections.
You need to trust your contractors. You need to stay on top of that. Like it's
like a career. That alone is what people do for. That's probably why it's like really lucrative for the people that can do it. But it's not just like I should flip a house this weekend.
Yeah, it is not for the faint of heart. I would say. Like kudos to the house flippers, but I will never do that.
Yeah. No, it's a specific type of person.
And I'm grateful because I feel like they really can improve areas. You know. Like people that go in and are like, okay, I'm investing, I'm flipping a house, I'm making this community better because I'm improving this residential whatever. I think that's really beneficial, but not for me.
Yeah. I have some friends that do like kind of half and half. So they'll go to a rental property, fix it up, refinance it, and then rent it out. Sure. So then they keep it, which I guess, again, is a big upfront time commitment and all that stuff because you have stuff to fix and everything. But then instead of just taking the big chunk of cash to sell it, now they just have a higher rent because they basically made the area nicer, or the property nicer.
Yeah, so people are willing to pay more because it's updated and nice.
Yeah, but then
all their stainless steel appliances.
Yeah, exactly. The white walls and everything. One of the biggest questions that I have personally, I think I have pretty good credit. Like I've worked on it for a long time. I've never made any big mistakes or anything. And what's the advice that you give to people? Probably do that every day to establish credit and to improve their credit.
Yeah. So the credit scores we like to work with are over 640.
Okay.
If you get below, it's a little bit harder. Your interest rates are higher, and things like that. The number one culprit I would say that people are totally unaware of is their balance to the total limit they can take out on credit cards.
Mm-hmm.
If that ratio is over like 25-30%, then that's considered high balance and it dings your credit.
Really?
So if you, it's not like it makes it so you have bad credit in and of itself, but that's like one of the things where if I pull somebody's credit, it's like, okay, there are a couple things we should work on. That's always one of them.
Like that it floats at that level or that it ever reaches that?
So that it, say they just like kind of run a $4,000 balance on a $5,000 limit.
Uh-huh.
So that's, they're running that pretty high.
Yeah.
So that just shows where it's funny if you go ahead and you up that limit to 20,000, then you're only at 20 something ish percent.
Uh-huh.
And doesn't hit your credit.
Ironically, you owe the same amount,
right.
But because you could.
It seems like more financially responsible to have lower limits on your credit cards, right? There are a few things with the credit bureaus that it's like, but really, why are you in charge again?
Yeah, like, that doesn't really add up.
No, but it is a thing. The other thing is old accounts. People are like, oh, it's definitely financially responsible. It's like, go ahead and close old accounts. Don't do that. Because you want your accounts to have a long credit, healthy history.
Interesting.
If it's got a bad history, close it. It doesn't matter.
Right.
Let's get that off your
Delete
credit.
It. Yeah.
Which it takes like 7 years to like fall off your credit naturally after it stops reporting. So anyway, it's the longer your credit history is, the better. Also, if you have like an old Kohl's card
Mm-hmm.
that you haven't used in like 10 years, it's better if you can, to go to Kohl's every once in a while, put a balance on there and pay. You don't have to pay interest on it, but just like keep it going.
Right. So it's active.
Right. So that when your credit, basically you want to pull credit and look like there's this healthy history, and for most people they're pretty responsible, but there's not really for a way for the bureaus to really determine that unless they have like open accounts that are actively reporting.
Uh-huh.
You know what I mean?
Yeah. So like it's better to maybe spread yourself a little bit wider if you're responsible. Right. Like have 5 credit cards but not get in deep with them.
But then if you forget to make your payments because you have 5 credit cards,
right.
So obviously late payments are a big deal. 30 days are not as bad as like 60 and 120 days, but all of them are bad and they will ding your credit like so much. So no lates, do not do that. And so, if you can stay on top of it, and some people it's like, no, I can only do 1 credit card. Nothing else. Like I'm not going to risk, and that's fine. Like that's fine.
The personality.
But if you really want to like maximize your credit and you can handle it, then get 5 or 6 credit cards, keep them with low balances, like trade off where you're buying things, keep them active, keep them liquid and going.
So you're saying like a good thing you could do is get 5 different credit cards and put like Netflix on one and maybe like your gas on another one. Yeah. And then couldn't you just make them automatic payments so that you wouldn't really risk?
But sometimes people don't do that. So.
That's what I've never understood because I hear a lot of fear about credit cards and I don't really get it because can't you just like set it automatically and not worry?
Yeah, I definitely think that the credit cards make money when you can't afford to pay off what you've purchased.
Right. Yeah.
So I think that can, be scary. Mm-hmm. But if you're just like, this is what you spend anyway, you may as well put it on the credit cards and keep paying it off with your income. Obviously, if you are only making $1,000, don't spend $500 at the mall. Yeah. Or you're just going to have a high balance and take like 10 years. You know what I mean? Like, and in the meantime, pay the 14% interest rate or whatever your credit card
basically
is.
never catch up to it. Yeah.
Right. So if you're doing it in a really like strategic way, it can really pump you up. So credit cards are kind of like, I'd say 3rd tier, and like vehicles, cars, like personal loans, that's like 2nd. Okay. And then mortgage is like going to be your highest. So
I just paid off our car, and my friend who works with loans told me that actually might not be good for my credit because it's no longer
right.
open.
So he's talking about like the open accounts and things like that. But you also don't want to pay interest on a car. So, like,
yeah,
to each their own. I'm not going to keep my car open just to, like, make my credit be 10 points higher, you know?
Yeah, and I don't know how at this point, can I even do that? Can I, like...
No, well, you paid it off, so unless you, like, started another loan.
Like, yeah.
Or, like, took back the payment, I've never heard of doing that.
I know, I'm trying to think, like...
But then at the same time, you have, like, a new account instead of an old account, so...
Yeah.
Anyway.
So for like the average person, best thing to do is if they're responsible, and that's kind of the caveat for everying. Like
right,
be responsible,
like,
but
like,
if you're,
I'm not saying you get 5 credit cards and put like $10,000.
Right. But like if you're disciplined about it and you're doing this on purpose, you could get 5 credit cards, keep a low balance, always pay them off. Yeah, that'll build your credit. Is there anything else? Other tips?
The balances is one. The account length is definitely one. So those are usually the top 3 that I have people consider. Obviously, if you've got like collections and things on your credit, then that's gonna hurt it. Collections can be tricky because they'll be reporting and they take like, you know, once you finally pay it off, then it takes like 7 years to like drop. So like there will be just a collection forever.
Yeah.
And so, but they're tricky because lots of times collections, so say you owe like $5,000, they'll offer like a payoff for like $2,500. So it's like, looks good, right? Because you're like, hey, I can pay this off. I'll be good. I'll have paid it off. You know, I don't have to pay an extra $2,500, which is nice.
Yeah.
But on your credit, it's not going to say that it was paid in full. So that's going to hurt your credit until it falls off.
Right.
So it's collections. If you can just avoid that altogether, obviously that's great. But then once you get there, there's a lot that can happen with it. So it's not like a great answer, but I would definitely say to anyone that has that, make sure you're like really researching what's going to happen. Like, if you do pay off something, like what are they going to report actually? Are they going to, you know, stop? You know, you need to make sure that you know what's going to happen to your credit first before you do it, because it can definitely hurt your credit because it's showing as paid, like, but not in full. You know, so that just shows your next creditor. Well, are they gonna bail? Like, am I gonna lose $2,500 on them? So, and
I've wondered this before too. Like, as a loan officer, are you on the line for bad creditor or is it creditors, people that you give credit to?
Like bad loans?
Yeah. So like,
sure. Yeah.
Like how does that work? Because like if you're looking through it and you're basically, are you the one who's actually like analyzing, hey, can this person afford this?
Right. I see what you're saying. So I do it initially, but then it has to go through like the mortgage gods that are the underwriters. And then from there, like if we were to pass the servicing to like US Bank and then they default, they're going to give it right back to us and we're going to be financially responsible for that.
Okay.
So there's definitely risks in things that we do as loan officers. So
is it more subjective than people know? Like, do you do things different than other loan officers? So like pretty analytic.
There are regulations across the board that pretty much everybody follows. I mean, there's definitely some like some loans that are like not standard loans that you can get that are like higher risk and different things and aren't really like industry standard. There's definitely that too. But I would say most loan officers like know, like if I'm competing with somebody on like on a mortgage, right? So I've got like my estimate, they've got their estimate. If my borrower comes to me and says they're going to do this program, this is what they're saying, then I know exactly what they're talking about because it's all like the same. Yeah. Does that make sense?
Yeah. So how do you differentiate yourself? Is that pretty hard in the industry?
So a big thing is fees and service, quickness.
Yeah.
Like if somebody's needing to get into a house and the seller is not willing to do like 2 months, which is what like a credit union takes to do a loan. Okay, I might be exaggerating a little bit, but they take a lot longer typically at like credit unions, right? So that definitely can set us apart because we can get a loan done in like 3 weeks, you know, like sometimes shorter depending on what the situation is, but 3 weeks is a pretty good amount of time to get a loan done. So I usually tell people 4.
Just to make them happy at the end.
But to get done in 3 weeks is like not unreasonable. So like it means that like you need to like give me stuff when I tell you to, like pay stubs, but like
what kind of things do people, obvious general things that they need when they come meet you for the first time?
Yeah, so to do like a pre-qualification, we either have to pull credit, or if you have an idea of where your credit is and like what your minimum monthly payments are for things, you have to know that information.
Minimum monthly payments.
If you've got 5 credit cards.
Oh.
And they each have a minimum monthly payment of $25 a month.
Okay.
I basically have to calculate what is their financial obligation from their other creditors. So I can do that by pulling credit, or if people are not ready and they're just trying to get an idea, I'll usually like take their word for what their credit is and say, but if your credit report comes back and
if you're lying,
this is not my fault.
Be honest for your own benefit.
Right, exactly. So usually I won't pre-qualify somebody, like give them a letter and everything. Well, okay, I would not do that because that would be very misleading. So usually lenders will give somebody like a pre-qualification letter once they've calculated everything, pulled credit, like have the financials, and they'll like sign it. Realtors will take it around and make offers with it, right? Saying they've already been pre-approved. So like, you can, this offer isn't, because what it happens all the time where people accept an offer and then their buyers fall through, their financing does. So having a pre-qualification letter is pretty good. So if somebody's not there yet and just trying to get an idea of like, okay, how much do I need to save, or how much, then I'll just kind of get an idea of where their credit's at. So that's going to be their score. That's going to be what their minimum monthly payments are. I need to know how much they can bring to the table for a down payment if they're not trying to do like a 0 down program. And I need to know their income. So that would be like bank statements, income, like pay stubs, W-2s, driver's licenses, because they have to be like legitimate. But so those are usually the documents is ID, bank statements, pay stubs, and pulling credit, or the general idea that they can give me. So that's usually initially what we have to start. And then once they get a contract going, if they're buying a house, then we get the contract, and then we have to get all sorts of other stuff.
And you're like all the way along the process?
Yes. Yeah. So it's me, and then I have a loan processor. There are a lot of things that I actually can't do myself for legal stuff. I just have to get verifications and things like that. I have to not just like go off of pay stubs. I need to like call their employer and say, hey, do they actually like work here and make this money? And can you provide this verification for me? So
can you can your income be verified by a job you have not started yet?
It can be, yeah. In some cases, it kind of depends on if it's going to be like a variable hourly or if it's going to be a salary. Like it's a lot safer, obviously, if it's salary. But if you have a letter from an employer saying they'll be starting on this date, it's not contingent on anything. Like it's not contingent on they have to pass this test or,
Like they already have an acceptance.
Right.
Because I thought for some reason that you had to have like 2 years of...
You do have to have an employment history of 2 years, yes.
Okay.
But say you're in school for like engineering for like 5 years. That counts as like being in the field.
Okay.
If you were in school for that amount of time, you prove it with transcripts, and then you're like starting a job in 2 months, and we get a letter from your employer saying, yep, that's legit, then we can totally do a loan on that. Okay. And then like as a follow-up, get like your first pay stub from them, as long as you're starting within X amount of time, whenever the loan closes.
So I've been confused by that because, if you're moving somewhere and like if you're moving across the country for a job, then you want to buy a house across the country, then it doesn't make sense for me. How would you have history at that company? But it's just work history. It's not
history. Yeah. Yeah. You're not supposed to have more than a 6-month gap of unemployment, like that's unexplained.
Right.
So like sometimes it'll be like I took medical leave or I'm on active duty for the military. I don't know. Like there's a lot of reasons why.
Well, that kind of stuff is valid, right? They would say if you had a medical problem, that wouldn't.
I mean, really, when it comes down to mortgages and like what you're approved for, like if it makes sense and you have like a substantial case to say so, like it usually is gonna work out fine. Yeah. So, I mean, if you've been like paid under the table from your employer for 20 years and like we can't prove your income, like I'm sorry your employer wasn't that legit, but like that's the most like negative thing I can see that's you know, not that kind of screws over a borrower, I guess, that isn't like their fault, you know what I mean? But most of the time if there's like something that's explained and like your situation makes sense, then it's going to go through. Unfortunately, if your employer was doing that, then your situation is then not making sense. And that sucks, but it's true.
I wonder that too about like, you know, people that do like day workers who do stuff for, will go like work in like yard work or something like that, right. Or go help build. They just get like paid in cash.
So if they report it on their taxes, then I can prove it on their taxes.
Right.
But if they don't, then I can't do anything about that.
Which I guess seems fair because then if they're not paying taxes on it.
Yeah, probably... it's like, well, if you didn't report, I'm sorry, you can't buy a house. Like,
exactly. Like that seems like a price to pay to be able to buy a house.
Exactly. You know, but there's, the one, and like I already mentioned it, it's the one that is really, it's really a hard pill to swallow is if you do have like a more sketchy employer. It's like, oh, I'll pay you this base salary plus a bunch of overtime, but I'm going to give you all the overtime in cash.
Yeah.
You know, and not track it. So.
So that I don't have to pay any taxes on it.
Right. Exactly. So it's unfortunate, but that happens. So even though, they make way more than they need to own that house, you can't, we can't just say, well, he says he pays you.
Right. Like, you got to look under my mattress. There's tons of money in there.
Yeah. That's actually another thing people need to consider too is usually not usually, every time. You need to have at least a month of like seasoned cash for us to like.
What do you mean?
So it has to be like showing in a bank account or be tracked some way. So if you had it in a 401k and pulled it out, like we have to see where it's coming from. Because otherwise we could be like super like they could be after us for money laundering.
Yeah.
So, I mean, because they could potentially be selling a bunch of drugs. Buy a house and be like, oh, I brought all this cash. I had it in the bank. I just did like a $20,000 deposit one day ago. You know. So that is something actually to consider is if you do have your money stashed under the mattress, which sounds funny, but people do that.
Oh yeah, for sure. Like underneath the oak tree.
If you're trying to like liquidate that and put it into something, like it needs to show that it's like a legitimate source of funds.
So put it into a bank account or something at least.
So I would say before you're trying to get a loan, just make sure it's not like, oh, I have this huge random deposit that I can't source. Like
seems pretty sketchy.
Yeah, exactly. So just make sure nothing looks like that or it's just a hassle for you. But obviously if you've got like your payroll coming in every time, then we're like, oh, well, they make $2,000 every 2 weeks and we can see that, then that's going to be fine. But if all of a sudden it's like, well, $50K.
Yeah.
All right. It's like, oh, it's from my dad. Well, that's legitimate, but your dad's going to have to write us a letter saying that that's legit. Right. And we're going to have to see it coming out of his bank account and going into yours.
You have to trace it somehow.
Right, exactly. So that is something, I like to tell people if they're a couple months out because you just need that time to make sure it's legit.
And right before someone gets pre-qualified, would you recommend basically paying down your credit cards to their lowest limit and just so it shows even more? Sure. Like last minute.
The only issue is every credit card company reports differently.
Okay.
So like usually they're only going to report like once a month. at the beginning of the month. So if you do that and then come to me the next day and I pull your credit, that's not what it's going to say.
Can't do it like an hour before.
So you could do that. Yeah, you could make it so your credit is more to your advantage for sure, but it takes a little bit more planning. So.
Do you do a lot of creative loans? Do you do anything non-standard?
Yeah, it kind of depends on the situation. I guess, are you thinking of a specific scenario or?
I was talking to a friend of mine and he was saying like, oh yeah, you can get really creative on loans. Like what was it? I know that you can get kind of creative on contingencies to protect yourself.
Sure.
Or like, hey, I'll pay this much I'll pay even more if we do seller financed or stuff like that.
Oh, I see. Yeah, there's definitely some creative ways to get into houses. With loans, like, I mean, we need to get through underwriting. Like, we do all of the upfront work, and then our processors verify all of our upfront work, and then our underwriters verify all of our work, and then it's approved. And so there's like a lot of stuff. But like, if you're talking real estate where it's like, okay, I have a 3% down payment, and that's all I have. I can't pay closing costs because obviously you're going to have to pay like some lender fees and some title fees. And we're going to have to get what's called an escrow account set up for your hazard insurance and taxes and all that. Like, we have to be able to pay those things. And so if you're in that situation where you're like, I do not have this much money for closing costs, then you can have your seller pay for those. So say they're trying to sell their house for like $150. That's really low. Let's do $250. So, and you offer $252 and ask them to pay $5,000 in closing costs.
Okay.
Like I think that's what he was probably saying, where you can get creative with, I can't get into a house right now, but I can get a 0 down payment. Like, I can get into that program and I can have my seller pay my closing costs. Then lots of people can get into a house that maybe didn't think that they could.
Right.
So.
This might be kind of putting you on the spot, but I'll just give you like some averages, I guess, and maybe you could tell me what you think they could pre-qualify for. Is that possible?
Like of income?
Like, let's say, I mean, average income is like, what, 50,000 in the U.S.?
Sure.
Let's say someone's making 50,000. They've got a 700 credit score. Their income 50,000. They're making what, like 6,000, 5,000 a month. Their debt is, I don't know, 1,000. Is that reasonable? Like, sure. Yeah. So
like 2 car payments.
2 car payments.
Yeah.
What in Utah? What do you think they could qualify for? Am I missing a factor?
No, that's a pretty good. I'm not technically actually supposed to quote things like that without having all the information, but I'll give you a really general window, so we're okay. Like, you'd probably be somewhere between like 225, 260-ish on like a purchase price for that. And that's being conservative.
Right.
It also depends on your down payment, right?
Right, what you can bring to it.
So, if you can qualify for it, $250 loan amount, and you have $100,000 to put on your down payment, then obviously that's going to be a $350 for you. Instead of, like maybe a 3 or a 260 because you only have X amount or whatever.
Gotcha. Cool.
So,
if people want to reach out to you, can I give them your information on this? How can they reach out to you? Like, to get a loan through you or be your client or whatever? How should they reach out to you?
Usually people just message me on Facebook, or they can text me or call me. My number is 801-358-5613.
So they should message you on Facebook if they want to get a loan through you?
Find me on, like, as Mortgage Mermaid or whatever.
Mortgage
message.
Mermaid?
I get a lot through there. And then, or just referrals that people have given my number.
Awesome.
So.
Awesome. Well, Mortgage Mermaid, Christi, thank you for being on the show.
For sure.
That was awesome.
Thanks for having me.
Yeah, thanks.